So far, in the previous portion of this lesson, we have seen that the company has earned a net profit of $3 million. And this entire 3 million belongs to the shareholders because the lenders of the money, they have received the interest, the government has received the taxes. So whatever remains in the form of net profit, that entire amount belongs to the shareholders. Now the company can do either of the things with this 3 million. It can either distribute the entire amount of 3 million as dividend to its shareholders. We know there are 1.8 million shareholders. 1 million are the promoters and another 0.8 million the public shareholders. So this entire amount, it can either be distributed as dividend to all the shareholders, or the company can reinvest this entire amount into the business and not give any dividend to the shareholders. That also is permissible because in either case, the beneficiaries are the shareholders only. The company belongs to the shareholders. Or the company can take a mid path. It can distribute some amount as dividend and the balance amount it can reinvest into the business. But each of these actions, depending upon what action the company takes, it will have an implication and effect on the share price of the company. Let us see how it affects the growth of the company. Consider two identical companies, company A and company B. What we are talking about, Five Friend Garments Limited. Consider there are two identical companies of that time. We will see how over the years the equity, net profit, dividend, retained earnings and the total owner's money evolve with changes. But before that, let us say that both the companies earn a net profit of 3 million on the owner's capital of 18 million. That we have seen. So it works out to 16.66% over the period of 1 year. And we presume, for the sake of understanding, that every year the earning or the net profit remains the same, 16.66%. Alright, just for the sake of understanding. So in the first year, the company A, it has got an owner's equity of 18 million. We know that 3 million is the net profit. And we say that the entire 3 million, the company has distributed in the form of dividend. So nothing in the form of retained earning. The company does not hold back anything. So at the end of the year, the owner's money remains 18 million only. Alright. But company B, what it does is, it also earns a profit of 3 million, but it does not give anything to its shareholders. It does not give any dividend. The entire amount it holds back as retained earning. So at the end of the year, the total owner's money becomes $21 million. Why 21? Because this 18, owner's equity and the retained earnings, both these things belong to the owners. So 18 plus 3, it becomes 21 million at the end of the year. Next year, what happens? Again, this company, over the equity of 18 million, because equity has remained 18 million, it earns again 3 million as net profit. And again, the entire amount it distributes as dividend. So nothing held as retained earning. Again, at the end of the year, the owner's money remains at 18 million. But company B, in the second year, now it has got owner's equity as 21 million, because here you see 21 million, 18 plus 3 had become 21. So it starts with a capital of 21 million. Over this 21 million, 16.66% profit, that means it earns a net profit of 3.5 million. Again, it does not give anything in the form of dividend. The entire 3.5 million is reinvested. So now the owner's money becomes 21 plus 3.5, that is 24.5 million. And this thing repeats year after year. So let us say what happens at the end of fifth year. Now third and fourth year, presume the same things are happening. So in the fifth year, again, the owner's equity for the company A would remain as 18 million. it would earn a net profit of 3 million, that is 16.66%. Again, it will distribute the entire amount as dividend, nothing held as retained earning. So the owner's money remains as 18 million. Alright. But what happens with company B? In the fifth year, the owner's equity would have become 33.34 million. This 24.5, third and fourth year we have not calculated here. So if you calculate, the owner's equity would become 33.34. And 16.66% profit on this equity would make it a net profit of 5.56 million. Again, the company does not give any dividend. The entire amount is reinvested. So at the end of the fifth year, the owner's money for company B is 38.9 million. Alright. So here it remains 18 million only. The company is stagnant, though it is giving dividend every year, but it is stagnant. It remains where it is. Company B, it is not giving any dividend. But see the growth. Its worth has become more than double. Now, as far as the share price of this company is concerned, the share price of company A would have remained the same or probably reduced to some extent. The share price of the company B would not have become 2 times, but it would have become probably 3, 4 or 5 times. Why? Because it is representing growth. Now let us see what happens at the end of 5 years. At the end of 5 years, company A would have an equity of 18 million only. Retained earnings are nil. And the total shareholders' money would be 18 million only because there are no retained earnings. But company B, the equity remains 18 million, alright. But there are also retained earnings of 20.9 million. This is the net profit which has not been distributed as dividend over the years. And therefore, the total shareholders' money will be 38.9 million. Now, company A is a good dividend paying company, but it is stagnant. It remains where it is. Company B is a growth oriented company. Remember that a good company will not distribute the entire amount of net profit as dividend. It may distribute some amount as dividend, but a major portion of the net profit the company would reinvest into the business. Because if the dividend is given to the shareholders, that dividend being a very small amount gets consumed insignificantly. But collectively, if that dividend is reinvested for the purpose of growth, then it helps the company in growing very fast. Now, what can the company B do with this retained earning of 20.9 million? Because ultimately this money belongs to the shareholders. What can the company do with it? The company can either use that money for its expansion, diversification, or growth. Because if the company is growing, diversifying, it benefits everybody, all the shareholders. Alright? Or if the company feels that there are no diversification or expansion plans, the market is not good, there is no scope for expansion, and the company does not want to keep this money idle with them, in that case, the company at some day may decide to return that money to the shareholders in the form of some special dividend. Alright? Or the company can utilize that money for the purpose of giving bonus shares to the shareholders. This money from the retained earnings, it will transfer into the equity head, and to the shareholders, the company can issue bonus shares at no cost. So these are the ways where the company can utilize the retained earnings. I hope the concept of profit, dividend, and growth are clear to you. So when you find that a company is a good dividend paying company, that does not necessarily mean that it is a good company. On the other hand, if you find that a company is not giving dividend or not giving adequate dividend, that does not necessarily mean that that is not a good company. Alright?